Good afternoon, everyone. This is Philip Toffel of Sage Hill Family Office. It is now April 7th, 2020. We've all been through a lot, so I hope that you are all healthy and that your loved ones and your colleagues are healthy and safe as well. I don't think any of us have escaped knowing someone well, including me, knowing someone who has passed from the coronavirus. So obviously we all know we're in tough times. But the purpose today, I'd like to take about 10 to 15 minutes of your time and just share with you a few thoughts as I sit here in my home office in Delray Beach, Florida. And fortunately, our team and my partner Frank Antelek and myself are the lucky ones. We are all safe. Our families are safe, we are healthy, and we are able to serve our clients virtually from our locations in Saratoga Springs, New York, and here in Delray Beach, Florida. Even though we can't have the pleasure of being with our clients right now face to face, our work does go on. And the work that needs to get done right now for our clients, who are very substantial, most of whom are either high eight-figure net worth, approaching $100 million of net worth, and many who approach $1 billion of net worth. So among our 20 client families, there's a lot to do. There are opportunities and there are safeguards that need to be installed right now. And robust communication is a must. So that's what we're doing. We're doing a lot of work on the estate planning side for our family business owners. Due to depressed values, there's a lot of opportunities there for us to make sure that the wealth and the family business is more sustainable. But that's not the topic of discussion today. My purpose today is to share with you just some high-level thoughts on the investment side of our practice and what we're focusing on and what we have focused on, and why our clients are really quite stress-free at this particular point in time, despite the fact that the equities markets, of course, have been all over the place for the past several weeks. And despite that, we are in a good place, and through good communication, we've been able to reinforce that. So hopefully some of this will be helpful to you in the future as you go through your process with your own financial asset portfolio. Today is not a pitch. Obviously, we do want to share with you our philosophy. It may be of help to you, but first and foremost, you absolutely should be in very close communication with your financial advisor, your investment manager, and unfortunately, we've seen and heard of too many cases where individuals of significant wealth, or perhaps not, but where their life savings and more has not been a topic of discussion with their financial advisor, and that is a real shame, and it's a significant disservice to those of you who have experienced that. So let's get beyond that. The issue at hand today is, again, we've seen the equities markets be all over the place over the past several weeks. The volatility index actually, fortunately, has gone down quite significantly over the last week. Today the market is up. Yesterday was up significantly. That's a good sentimental feeling, clearly. People now have more hope, and we all want this to be very successful, that's for sure. But in terms of where you are now with your investments, the first question is, have you stayed in there? Or did you cash out? What is your advisor telling you? What are the recommendations provided for you? Stay the course, make some adjustments. Do you go more towards equity income versus more growth-oriented portfolios? How about domestic versus international? There's issues that need to be discussed. How about tax planning, capturing tax losses versus some gains that you may still have? These are all question marks that need to be addressed and deserve to be addressed right now. So there's the number one issue, where are you today in terms of your portfolio? Uh, then the next somewhat obvious issue is, should you stay in there? How much more volatility are we going to see in the equities markets and bond markets as we go forward? There are many different opinions out there among the economists and significant advisors out there as to whether it's going to be a V shape where it'll snap back very quickly in terms of the market. The market is normally ahead of the economic measures. So we will have to see. No one really knows. This is very different from 2008. It's very different from 2001 and 2002. So it has very different dynamics. And these events do come out of nowhere. This is not totally unusual or totally without precedent in terms of there being a very catastrophic event that has caused the equities markets to be so disruptive. We look back to 1987, look to the Russian ruble crisis, we look at the internet bubble, right? But this is different than 2008, which was more systematic in terms of the particular downfall of the equities markets. So, nevertheless, are you going to stay in there? Is a big question mark. Do you have where are your emotions right now? The emotions need to be paralleled with the technical side of your investment portfolio. Square one is, how dependent are you on your financial assets for your lifetime financial independence? That's square one for us. Doesn't matter if somebody's net worth is $2 million, 20 million, 200 million, 500 million. That needs to be square one to really lock down your financial independence needs. Because even if somebody has $200 million, their lifestyle oftentimes represents that level of net worth. And where's the cash flow going to come from? And what's the most tax efficient way to get it there? And also, you can't avoid the motions, the emotions, in that when the equities markets do suffer as they have recently, and the equities markets generally go down 20, 30% or more, very few people are exempt from the emotional side of what's going on. So what can you do to potentially offset those downturns? And we have ideas for you. But the emotions cannot be ignored. And one of the very good reasons why they can't be ignored is what does happen generally, and every one of us is different with our emotions and our portfolio and so forth. But even if the technical side is locked down, you've done your analysis of what you need for your financial independence, what you need for your charitable obligations that you've made, your family needs, contingencies, right? You lock that down just as you would your business. So once you've done that, the issue then on the emotional side is, does the portfolio enable you to keep your stress level low as it goes forward? What happens generally is people will get out of the market, go heavily in cash, in many circumstances go to bonds. That's another issue for today. But nevertheless, they are usually very hesitant to get back into the equities market. And it's very interesting when you look back. For example, you look back 20 years, a little over 20 years before the internet bubble. If you had put $100, just as a round number, into the S&P 500 index on January 1st of 2000, in today's world, even with some of the ups and downs recently, you would have well over $300,000 in that, $300 against a $100 investment back then. And that's before the internet bubble. It's before the 2008 financial crisis and so forth, and before what's happened just very recently. And that's if you stayed in there. If you were not in the market, in the S&P 500, for the 10 best days, if you just tried your best to time it, and just 10 days out of what, 20 years, that's about 7,000 days. If you were not in the market for the 10 best, your $100 would turn into about $160. If you were not in the S&P 500 for 25 days, 25 of the best days, out of that total of, again, 7,000, about 7,000 days, you would have lost money. Isn't that amazing? So it's not about gambling, but it's about having the emotional fortitude to stay in there, and also the rationale behind that in terms of being smart about staying in there. So what do we think is smart? There are several instruments out there, and you don't have to be a billionaire to invest in some of these instruments. And I'm not here to pitch instruments to you, because there are a myriad of them out there where the most major investment banks in this country, the most credit-worthy insurance companies, financial institutions generally, that provide guarantees to its investors. And there's a whole garden variety of these instruments out there. But if you stay at the top of the pyramid of the most credit-worthy ones, the credit-worthy investment banks and financial institutions, so that the guarantees have real meaning when you need to be on the other side of the investment, which typically would be, let's call it 3, 4, 5 years. Obviously, you need to make sure those guarantees are going to be fulfilled. So at the end of the day, these institutions are willing to take a lot of risk out of your particular investment, and they have their mechanisms to hedge. These are the world's experts in the room, the guys with the visors on, who are using various hedging techniques in order to support these guarantees. And they obviously make money to do that. That's what they do. So, but at the end of the day, these guarantees in a situation like today are so meaningful for Sage Hill clients and for clients generally. We're not the only ones who conduct ourselves in this manner. Unfortunately, and this is not meant to be throwing stones, but it is reality, the vast majority of portfolio managers out there and financial advisors, the prescription they have for their clients' portfolios are a balance of equities, domestic, foreign, growth, value, bonds, bond funds, cash, alternative investments. And typically in times like this, the prescription that they have for people is you need to stay the course under the same type of philosophy I just posed, and that is you have to be in there for those spikes in the market in order to participate for the long haul. Emotionally, though, that's a tough drill. It takes a lot of courage, a lot of sleepless nights along the way. So our philosophy, which has proven to be successful through these different problem areas over the last 20 years, has been to take advantage of a lot of these guarantees that these major institutions do provide for Sage Hill clients. And then for Frank Antelek, as our chief portfolio strategist and an economist as well, to oversee all of the different instruments and the cash flow needed for clients. For us, having a relatively small number of client families, this is something that's manageable, having a little over 20 families whom we serve as a family office. If somebody has 2,000 clients, they're not really clients, I think is the fair assessment. They're customers, and there's a major difference in terms of the relationship between advisor or family office with a client and someone who has a customer as opposed to a client. So nevertheless, in either case, you deserve attention by the person whom you are paying to provide service for you. So at the end of the day, I'm just going to give you a very brief chart here, which is going to illustrate, and hopefully this is something you can see on the screen here, but very, very generally, if in fact this, for example, you see the line going from my bottom left up to top right. And that is generally the scale of the equities market. And here's minus 50, and here's plus 50. And across this axis is going to be a timeline. So generally speaking, equities portfolios, indices, if you're looking at that as the fulcrum here, in a better world, wouldn't it be nice if you can still capture all, most, or even more sometimes of the upside, but on the downside, that you don't suffer that, but you have more of a level playing field on the downside. Now that sounds like best of all worlds, but this is why you pay investment banks oftentimes for instruments where they're taking the risk out of your portfolio on the downside, and they're getting paid well to do it, and they are investing in their own right in different instruments and different options trading and the like, to hedge the portfolio. It's not for amateurs, and it's something that people wake up and do every day for that, those team members of those investment banks. So you have to have the all-stars performing those functions. It is not for the faint of heart, and it's not for amateurs. But there are experts, they know what they're doing, the ones who do it well. So when it all filters down to the client, at the end of the day, through times like this, when they've dealt with instruments issued by the best and most creditworthy investment banks in the world, who are providing guarantees, they're applying the gray matter to these particular instruments behind them, and providing guarantees for clients. They are not risk-free. I'm not here pitching one particular type of instrument, but they never are risk-free. Oftentimes there's a liquidity risk, for example, that they are not usually very liquid in terms of these investments, regardless of which one you would choose from. So nevertheless, a lot more detail that one needs to go into. So just a few more moments. I'm at the 17-minute mark here, and I don't want to abuse your time. But on the bond market side, be very, very careful. There is not a lot of liquidity in the bond market. A lot of advisors we have seen have gone out and liquidated equities, have acquired bonds for clients over the past month or so. And of course, interest rates are at historically low levels on the bond side. So they've done that to secure their clients' principal. However, on the bond side, we are starting to see a little edge up in the interest rates on the Treasury side. And when interest rates go up, the value of the bonds go down. So those are the dynamics of what occurs. If you hold it to maturity and you have a good credit like U.S. Treasury or a strong corporate rating, you get your money back, right, in terms of the maturity of the bond. But also, if you hold bonds, which many of our clients do that have higher interest rates, and they would command, at least empirically, a good strong premium today, because you're actually buying a bond from someone else that might have a 3, 4, 5% tax-free return in given states, for example, in the municipal market. But the market is very dry. There's not a lot of buyers right now. So how do you capture that gain, which is something we pursued, is a real challenge. So to hedge against rising interest rates is another art form, if I may, in today's world. And my partner Frank Andelek has been very active on that side of things as well. So there's not enough hours in the day. We've been working very, very hard on these issues, as well as the more strategic issues for our clients, particularly family business owners who have a lot of issues, a lot of stress right now, and we're here for them. But when you get ahead of these issues, and I submit to you that we believe we have, And I think that is showing up right now in the relative calm of our clients. They're able to take care of their families and be in safe places. And many of them still manage their businesses, try to protect their employees, as well at the same time. Very challenging times, obviously. And we're doing everything we can to help them as well, in our support of them, and to be very active. I hope this is helpful for you today. We are here to help you further if you need help at Sage Hill Family Office. But today, my purpose today was just to share some of the ideas with all of you. And I know virtually everyone, most of you face to face, who will receive this particular video. So as we're all saying right now, be safe, and hopefully within a few weeks, our country will open up at least a little bit where we can have some social interaction, albeit maybe it'll be at 3 feet then, rather than 6 feet today. We'll get back into the gyms and back into restaurants occasionally and be able to socialize with one another. We're all social animals, and we need that human interaction. So it's one of my reasons today to be human about it and reach out via video rather than a typical written essay. So best to all of you. Have a good day. Bye-bye.